What is up, guys? Welcome back to the channel. If you're new here, my name is Nathan Scott. If you've seen any of my other videos, you can tell that today's setup is a little different, right? I'm actually just gonna break things down in a PowerPoint today. I think it's super beneficial just because it's kind of a visual learning approach. So in today's video, what we're gonna talk about is the different type of stocks, right? The growth versus value versus dividend stocks, the key difference between the growth and the value stocks. I'm going to give you an example of each one. The more we get into the video, you'll see on each slide I have an example of what these companies actually are. I give you some key characteristics to look into when deciding whether it's growth, value, or dividend stock. You have some key elements to look into. So without further ado, let's get started with today's video. So to understand exactly what a growth stock or value stock or dividend stock is, you probably need to know what just a simple stock is, right? So a stock or equity is a security that represents ownership share in a company. So when you buy a stock, you are actually buying a portion of ownership in the company. So if you buy a share of Apple, you can say that you are an owner in Apple because you have bought a share of that company. Now, the definition of security is a financial instrument that can be traded. And this is typically an asset, and an asset being something that makes you money off of your money. Not a liability, which is usually something that takes money out of your pocket because you're having to put money into it. Now, a huge benefit for companies when they're issuing stocks is it's a great way to raise money and invest it back into their business. While at the same time that they're doing that, though, they're also helping investors because investors can grow their money while investing in these companies and outpace inflation on average over time. The typical return in the stock market is roughly 8%, and you'll see that in one of the upcoming slides. So now that you know what a stock is and some of the benefits that come with it is, let's look into a growth stock. So what is a growth stock? A growth stock is any share of a company that is anticipated to grow at a rate significantly above the average growth rate of the market. So like I said, the average return in the market is around 8%. These are companies that are typically more volatile. People will kind of shy away from these if they're not necessarily into a higher risk investment. So some characteristics that I marked down about these are they have a higher price to earnings ratio, which is also called the PE ratio. If you have Robinhood, you can see the PE ratio at the bottom around most of the stocks. More volatile than the broader market, they're often considered a risky investment, like I said, and they generally do not pay dividends. However, I did put Apple in here because, in my opinion, they are more of a growth stock rather than a dividend stock because they pay I believe it's 1.44% dividend yield. I'll get more into that later in the video. But in my opinion, they are more of a growth stock because they're not someone that advertises themselves as a high dividend company like AT&T did and some of the others I'll talk about later on. So the PE ratio. I kind of wanted to include this in there. That way you could see you can do your own math for yourself if you wanted to. How to find out the PE ratio, you divide a company's stock price by the company's earnings per share, or EPS. Example here is if company X's share price is $100 and the earnings per share is currently $2, then the PE ratio would be 50. The higher the PE ratio, this can symbol that investors are expecting a higher return on investment in their money. The average PE ratio based off the S&P 500 is between 13 and 15. So anything that's usually around 25 and above is a company that investors are expecting a higher return on their money. Now let's talk about a value stock. A value stock is any share of a company who is performing better than what their current share price represents. Key word here is current share price. Notice how that was not put in with a growth stock, right? So example here I wanted to give you was, let's say company X's share price is $20. However, their earnings, sales, and cash flow are close to or equivalent to their competitor company Y, whose share price is $40. So if you're seeing this, if you see that their earnings, sales, and cash flow, and there are other factors that go into this as well, but if you see that these are relatively close, then this should tell you that this company is potentially undervalued, and you have some room to grow with that share price and potentially make a decent bit of profit. Some characteristics of a value stock is they're typically mature businesses. You see steady growth rates on their charts and typically will pay dividends, but not all will pay dividends. And 3 examples I decided to throw up for you guys here that either I currently own or that I plan to invest in the near future are Bank of America, Procter & Gamble, and ExxonMobil. So now you know what a value stock is. Let's move on to a dividend stock. Okay, so what is a dividend stock? Well, in order to actually know what a dividend stock is, we first need to find out what a dividend is. So a dividend is a distribution of profits by a corporation to its shareholders. I like to say that this is a way of that company saying thank you for holding our share. We really appreciate it. So now that you know what a dividend stock is a share of a company that pays out regular dividends. These can be paid monthly, quarterly, semi-annually, or even annually. And when they pay is based off when the company decides. So there's no like regulation on it. It's strictly whatever the company wants to pay or when they want to pay, they can choose. Now, characteristics that you want to look for or that are typically found in good paying dividend stocks are they're typically well-established businesses. You want to see an increase in the earnings per share or EPS and a good dividend growth history. I always will go to Google when I'm typing in the stock and I will check for, let's use Coca-Cola as an example. I'll go to Google, I'll type in Coca-Cola dividend history. I'll pull up a chart and it'll show me the last 10, 15, 20 years, so on and so forth. Or you can typically find out how long they've been paying. It'll usually show as far back as soon as they started paying a dividend. I will look into that and I will decide then, okay, they've shown a constant increase, or maybe not an increase, but they've kept it the same for X amount of years. And for me, as long as I see 15 years or more of the dividend staying the same or constantly growing, I will typically do a little bit deeper dive into this company and I will usually invest. Because mainly what I'm looking for is over that 15-year period when 2008 or 2006 through 2008 hit, the stock market didn't actually start recovering until 2009, 2010. So I see, were they able to increase throughout that major bear market, one of the biggest ones we've had in history of the stock market. And then I'll look into 2020, right? Corona hit, and I'll see, kind of what that stock is doing through those two very rough periods of time. And if they either kept it the same or grew their dividend, then that tells me this company has their financials set up correctly and they can handle what's to come in the future more than likely. And the last thing you want to look for is a sustainable dividend payout ratio. This is also known as the dividend yield, and I typically won't invest in a company if their dividend yield is around 7% or higher. I do have some riskier investments that do pay higher than that, but typically I try to stay somewhere between 3 to 5 or 3 to 6% for myself. Now, the dividend yield is a financial ratio that is expressed as a percentage that shows how much a company pays out in dividends each year relative to its stock price. And I put an example in here. Company X pays a dividend of $1 per share annually and currently has a share price of $20. So you divide 1 by 20 and you get 0.05, right? So 0.05 times 100 equals 5. Therefore, the dividend yield of Company X is 5%. So that's kind of the sweet spot that I look for. Like I said, somewhere between 3 to 6%. I do have some that pay 7, 8, 9% dividend yield. One of my favorite dividend stocks that I did have was AT&T, but I did have to sell it. I'll link the video to that up top as to why I sold it. But the companies I have listed here, Coca-Cola, Altria, Verizon, Realty Income, these are all, in my opinion, very good dividend stocks. I did just shift out of Verizon because the growth wasn't there. Over the last 2 years, I've held their share, or I've held a couple shares of their company, and I ended up losing money on the share price. And even with the dividend yield, them paying me dividends, I ended up losing money totally there. So I decided to move towards something that paid a decent dividend and also showed some promise for growth. Altria Group is actually the maker of Marlboro cigarettes. The tobacco industry has proved pretty consistently that they're a fairly recession-proof industry. So I did just purchase some shares of that not too long ago. Realty Income is a REIT or real estate investment trust. I'm a huge fan of REITs. I have been diversifying my portfolio a lot to REITs. The growth potential that they provide right now with the talks of higher interest rates, they can see some profits coming in with that. Coca-Cola is a very steady moving stock as far as share price goes. It doesn't move too much, maybe $5 up or down. They pay a pretty good dividend. However, I did just sell some of my shares in them because, like I said, I'm moving to something that's a little bit more progressive of a company and shows me a little bit more potential for growth and rise in their share price. But if you're more of a safer investor and you just want in for the dividends, I highly recommend you check out Coca-Cola and Verizon. If you like a little bit of growth, definitely check out Realty Income. There's a couple other REITs and some of my other videos that I talk about that I would highly suggest you look into. But that brings me to the end of today's video. So thank you guys for watching. Be sure to like and subscribe. I put out a video every single week on Monday. I'm not sure if I will put up a video next week because I am getting ready to test for my California real estate agent exam, the state exam, which is on the 31st. So I may be focusing more on that this week. We'll see. So part 4 may come out the first week or after the first week of September. We'll have to see. But thank you guys for watching. I appreciate it. I'm going to leave a link below to Robinhood, Acorns, and Webull. So if you guys want to get started investing today, you can, and we can get some free shares together. So you can start out at the gate with a little bit of profit, right? But thank you guys for watching. I'll see you next time.